GE Vernova Inc. is trading at $621.33 USD, showing a sharp decline of $64.95 or 9.46% during today's session. This sudden drop stands in stark contrast to the massive optimism we saw just a week ago when the stock touched an all-time high of $731 USD. While the broader market is grappling with a retreat in tech and climbing bond yields, what's happening here is more than just a sympathetic move with the S&P 500. It is a violent recalibration of value. Investors who were chasing the highs after the recent investor update are now facing a harsh reality check. The expectation was that the massive tailwinds from artificial intelligence and grid modernization would provide a floor for the valuation, but the reality is that even the strongest fundamental stories can get ahead of themselves. When a stock doubles in a year, the market eventually demands a pause to see if the execution can actually keep up with the narrative. Today's move is particularly striking because it follows a period of extreme institutional accumulation. For months, the consensus was that this company was the ultimate play on the electrification of everything. The demand for gas turbines, grid software, and wind technology seemed insatiable. However, today's high-volume selling suggests that some large players are locking in gains or repositioning as macroeconomic pressures mount. If you are using a Fidelity trading platform or checking your positions on the Robinhood app, seeing a nearly 10% red day is enough to trigger a lot of questions. The curiosity loop here is not about whether the business is failing, it isn't, but rather whether the market has already priced in the next 3 years of growth in just 3 months. This is a classic case of the narrative outrunning the numbers, creating a vacuum that today's volatility is starting to fill. The common belief on retail traders on investing sites is that the massive backlog, which is approaching $200 billion by 2028, makes the stock a safe haven. The logic is simple. Data centers need power, and this company provides the turbines and grid infrastructure to make that happen. But here's the contrarian take that most people are ignoring. The backlog is a double-edged sword. A massive backlog requires incredible operational efficiency and a stable supply chain to convert into actual cash. Any hiccup in raw materials or labor could turn those future profits into a liability. We are starting to see concerns about the supply of rare earth elements like yttrium, which is used in turbine coatings. If the company cannot secure these materials, the ambitious 2028 targets start to look fragile. This is the friction between the theoretical growth story and the physical reality of industrial manufacturing. Looking at the intraday activity, the volume has been significantly higher than the daily average. This indicates that we aren't just seeing a lack of buyers, but active exit by certain cohorts. When we compare this to the price action of other high flyers like Nvidia stock or even Tesla stock, we see a pattern where the initial excitement leads to a blow-off top, followed by a painful period of consolidation. For someone managing a self-investing strategy, this is the most dangerous phase. It's easy to buy when everything is green, but when a leader in the sector drops 9% in a single day, it tests the conviction of every individual brokerage account holder. Whether you're using Interactive Brokers trading tools to analyze the technical support levels or relying on SoFi Invest for a more automated approach, the data shows that the 600 USD level is going to be the next major psychological battleground. One of the reasons this drop feels so heavy is because the expectations were set so high during the December investor update. Management basically told the world that their revenue would hit $52 billion by 2028, with margins jumping from 14% to 20%. That is an incredible promise. In response, analysts at places like Wells Fargo and Goldman Sachs immediately raised their targets, with some even calling for the stock to hit 1,000 USD. This created a frenzy. When every analyst is shouting buy, there is no one left to buy, and the slightest bit of bad news or even a simple macro shift causes a stampede for the exits. This is where the gap between expectation and reality becomes a canyon. The reality of today's market is that bond yields are rising, making high valuation industrial stocks less attractive compared to safe yield. Let's talk about the business itself for a second to put this into perspective. This isn't some startup, it is a massive industrial giant that was carved out of General Electric. They operate in three main segments: power, wind, and electrification. The power segment is the cash cow, focusing on gas and steam turbines. The electrification segment is where the growth is, dealing with grid solutions that are desperately needed to support the AI boom. The wind segment has been the problem child, struggling with profitability in offshore projects. While management is working to fix wind, the market is primarily focused on how many gas turbines they can pump out to satisfy the hyperscalers. If you look at your Fidelity mobile app and see the growth in their backlog, it's easy to stay bullish, but you have to remember that this is a long cycle business. These aren't just software licenses that scale instantly, these are multi-ton machines that take years to build and install. In the current environment, the pressure on the grid is the main driver. Data centers are expected to consume a massive amount of the total electricity in the coming years. This is why many people are looking for investment help to find the best ways to play this trend. Some are choosing Schwab Intelligent Portfolios to get a diversified mix, while others are active on the Robinhood trading platform looking for individual stocks. The reality is that GE Vernova is at the heart of this. They recently acquired the remaining 50% of Prolec GE transformer manufacturer to strengthen their grip on the North American grid. This was a smart move, but it also cost $5.28 billion. In a world where cash is king, large acquisitions add another layer of execution risk that the market is now weighing more heavily. Institutional activity has been a major factor in the stock's 400% rise since its IPO. We've seen mutual funds and foreign institutions pile into the name, viewing it as a cleaner, more focused version of the old GE. But when the price starts to slide, these same institutions often have stop losses that trigger further selling. This creates a feedback loop. If you're checking your Interactive Brokers account and seeing the put-call ratio rise, it's a sign that the sentiment is shifting from greedy to protected. People are buying insurance against a further drop, which usually means more volatility in the short term. It's a classic rotation out of winners into more defensive areas of the market. Before we go any further, I want to hear from you. Comment below how many shares of GE Vernova you currently hold, or if you're waiting for a specific price to start a new position. Also, do you think the current pullback is just a healthy correction or the start of a longer downtrend for the energy sector? Let's get a discussion going in the comments about how you're managing your portfolio right now. Looking ahead, there are several catalysts that could either stop the bleeding or accelerate it. The first is the upcoming quarterly report. The market is expecting earnings of $3.05 per share. If they miss that number even by a few cents, the 9% drop we saw today could be just the beginning. The second catalyst is the progress on their wind division. If they can show that they are actually turning a profit on those projects, it would remove a major overhang. On the other hand, if we see more news about supply chain constraints for rare earth elements, the stock will likely stay under pressure. The reality is that the energy transition is a slow and expensive process, and the market's patience is often shorter than the time it takes to build a power plant. For those of you using online investing tools or a Fidelity brokerage account to manage your retirement, it's important to look at the long-term trend. Despite today's drop, the stock is still up over 100% year to date. This is a massive outperformance compared to the broader market. When a stock moves that much, a 10 or even 20% correction is mathematically normal. The problem is the emotional reaction it triggers. Most investors aren't prepared for the volatility that comes with a high-growth industrial stock. They expect it to act like a utility, but it's priced like a tech stock. This mismatch in expectations is what creates the drama we are seeing in the price action today. The business model here is based on a razor and blade strategy. They sell the massive equipment, the turbines and transformers, and then they sign long-term service agreements that provide recurring revenue for decades. This is why the backlog is so important. It represents years of guaranteed service income. But again, the reality is that the market is currently more focused on the razor sales to data centers. If that specific demand signal weakens, or if tech companies like Apple stock or Nvidia stock see a slowdown in their infrastructure spending, the ripple effect on GE Vernova will be immediate. We are seeing a bit of that today as tech stocks broadly retreat. If you are a self-investing enthusiast using the Robinhood app or SoFi Active Investing, you have to decide if you believe in the multi-year targets management laid out. They are aiming for $52 billion in revenue by 2028. That is a bold goal.